It's Wednesday evening, July 21st, and it's time for the weekly swing trading video. Let's start with our only position that we have on right now, Baidu. You can see one, two major support levels here. We're testing that support level again. 1, 2 touches here. The stock has a tendency to rally off of these lows, just like we saw here. I'm not going to place a limit order right now. These options expire in August after the earnings announcement. So we've got plenty of time. Let's wait and see what happens. When the stock starts to rally like this, then I will set a target. I want to make sure that that momentum is starting to slow down, and then we'll look to pair our losses. We are going to take a hit on this one. I really want to stay on the sideline. The market is not giving us anything to look at from a longer term swing perspective. And I know for some of you that's hard to understand. How can this possibly be? If you've been in a number of trades that we've done over the course of the last 6 months, you know that everything goes beautifully. Oh my gosh, look at this. It's working out great. And then a couple of days before expiration, wham, we get these sell-offs. Everything's beautiful, wham. And it happens just before that monthly options expiration. So there is a pattern that's starting to set in. I personally believe that proprietary trading firms have caught on to what's going on, and they know that in the last 3 days of expiration, again, I'm referring to the monthly expiration cycles, that they can put the hurt on put sellers and force them to buy those puts back in by creating a market drop. And I believe that there's a lot of open interest and a lot of people that are short that put premium. We know that because there's actually a volatility skew right now in the marketplace. That means that calls are more expensive than puts. Well, why would that be? It's because people are selling puts and they're buying calls. It also tells me that asset managers are not hedged like they normally are. Typically, asset managers have a giant basket of stocks and they buy out of the money puts for protection. Well, when those puts keep expiring worthless and expiring worthless and expiring worthless, it's viewed as wasted money. And so asset managers stop buying those puts. That also makes them cheaper. The bottom line is this: one day a stock looks great, the next day it looks absolutely horrible. And you don't see it on the surface here, but there's an incredible amount of sector rotation as well. So the best thing for us to do right now, I've tried for the first 6 months to make something happen in the model account, hasn't worked out well. We're currently down about 30%. So I'm going to wait on the sidelines for a better opportunity. That better opportunity is going to come off of a sustained drop in the market. When we get these drops like we had this week, here's the close on Friday. So I come in Monday. I have no idea what the market's going to do on Monday. I know it's down big. Is it going to continue to fall? It did. It fell really hard. Is that going to break this 50-day moving average and test the 100-day moving average? If that happens, I don't want to be out there selling bullish put spreads because I've got a world of hurt ahead of me. Lo and behold, Tuesday morning, the market actually gaps higher and it never looks back. Well, because I'm sending instructions before the market opens, I don't know what's going to unfold throughout the course of the day. If I had even an hour notice where I could evaluate price action and send those alerts out, it'd be a different situation. But this was really intended to be for swing traders who have a 3 to 4 week time horizon, who can't watch the market all day. So I'm not going to change those rules midstream. I simply have to wait for market conditions that conform to that type of trading. A sustained market drop will give us multiple support levels that we'll be able to evaluate, and we'll have a chance to evaluate the stock and its relative strength over a longer period of time. A one-day drop is not going to do it for us. And it's the same thing that we had happen right here. We get this big drop and a close below the 50-day moving average. The next day, boom, like nothing happened, off to the races. Great for day trading, great for some overnight swing trading. Not good for swing trades that have a 3 to 4 week time horizon. So we'll be vigilant. I'm going to keep looking for opportunities. We've got earnings season coming up. Hopefully there'll be an opportunity in there for us. I'm going to go into Pop Bull and I'm going to take a look at some of the stocks and I'll show you some of the different setups. Now, if you've been following my daily videos that I post on YouTube, I'm going to use 3M as a classic example. Last week, I believe it was maybe Tuesday, I had mentioned I really like 3M. Look at this nice upward sloping trend line here. We've got earnings coming out on 7/27, so I liked selling the 7/23 bullish put spread, and that would have been keying off of this $200 price point, which is the 100-day moving average, and selling the 200 puts and buying the 197.50s and doing that for a 50-cent credit. We had a number of members who did that trade. Everything was looking good. Then we get the sell-off on Friday. Uh-oh, we broke that 50-day moving average. That's not so good because we were leaning on that. Now the stock drops down to the 100-day moving average on Monday. Ooh, really not good. What should I be doing here? Should I be legging out of this spread? If you can't watch the market intraday, you should not leg out of those spreads. And I typically evaluate out of the money bullish put spreads at the end of the day. Why? Because on a day like this, I'll let that stock move around. I'm more interested in how it closes than what it does during the course of the day. So if this 100-day moving average was my drop dead stop out point, you can see the stock fell below it during the day, but it bounced right back and it finished near its high of the day. And then what did it do yesterday? Hello, we're right back above the $200 strike price. Now we're only 2 days out from expiration. The spread is out of the money and it's looking pretty good. This is typical. This is exactly what's been happening. So really tough environment. And here you can see the drop that we had on Friday. There's the drop on Monday. Uh-oh. Well, actually, a number of members in the chat room did leg out of 3M, but it's very, very dicey. It's hard to leg out of bullish put spreads because you have to buy back your short put and then you have to sell your long put. You need that market drop to get the stock to continue to go lower so that you can leg out of it successfully. And if you did not handle that properly, oh, you took a world of hurt because yesterday the market flew right back. It's better for us not to even attempt trades in this environment. I had another video last week, Home Depot. Looked fantastic. Loved it. Looked like a really nice setup. Go into the daily chart, and we had this beautiful breakout right here. This was the candle and this was the day on July 16th. I recorded the video. Well, the day started off great. The stock was above this horizontal resistance. It's been in a compression. It's been hugging that 50-day moving average. So we have the 50-day moving average that we can lean on. We have this horizontal support with these two lows right here that we can lean on. Everything looked great, and it looked like this stock was going to break out. In this instance, these compressions, I like to buy calls, and that's what I put in my video. I said, this is a stock I would want to buy calls on. So by the end of the day, the market starts to deteriorate. This was on Friday. Not so good. Stock loses the breakout, and it closes on the low of the day. Tuesday, it breaks below the 50-day moving average, and it's testing the lower end of that compression. Then it bounces right back. So here we go again. Another instance where the stock looks absolutely fantastic. It's going to go, this is a nice breakout, to looking horrible the next day. I don't want to put us in that type of situation, so we're going to wait on the sidelines. I believe that the market is going to struggle a bit after earnings season. August is typically a very soft month. That's when we see a lot of market selling. Once those mega cap tech companies announce earnings, that is when you start to see some selling pressure. And if we go back into the last earnings season, you can see And in fact, we could even go back to the January earnings session as well. And let me take a look at where we were in January. And we'll take a look at each one of these cycles. But this is where we were in January. And this is when the mega cap tech companies announced earnings. Wham! We get this big sell off once they're done announcing earnings. So if we fast forward and we go into the same timeline in March, let me try and find that timeline, comes into play right around in here. And then we get this drop. I think we're going to see similar price pattern again once these earnings announcements go through. So I'm looking for a nice little rally. I think the big tech companies are not going to have an issue with higher prices because they don't have a lot of raw materials that go into their products. For instance, Facebook, Google, they don't have a lot of input costs. Amazon does from a shipping standpoint. Microsoft, not so much. Apple may have some supply disruptions, but supply disruptions and higher input costs could hamper profits for many of the companies. And those earnings expectations and earnings estimates have been ramped up at a rate that we have not seen in many, many years. So the bar is high. The expectations are high. That tells me that the surprise component favors the downside. I'm not looking for anything nasty, I'm not looking for anything ugly, but I do believe that we're going to see some softness. We'll wait for the market to come in, and perhaps instead of having a 1-day test of the 50-day moving average, we linger around for at least a few days so that we can evaluate how stocks are responding. Then we'll also have a chance to put some targets out there to try and get some of our spreads done. So August and September are typically weak months. There are a couple of red flags that I've been mentioning in my daily market comments. China's market is in bear market territory. They've got a 10-month economic head start because they emerged from the coronavirus earlier than anyone else. So why is their market down 50%? Or excuse me, why is their market down 20% from the high? Why are gaming revenues in Macau down 73% 2019 versus 2021? They should be back on track. 73%? That tells me nobody's going to the casinos. What's going on? These things just don't add up. There are many, many other warning signs as well with regards to China. Container costs. I've mentioned this previously. You've got Mattel and Hasbro sitting on mountains of toys in China that are never going to make it to market. Excess capacity. There's no doubt there's excess capacity after 20 years of hyper growth. Are there some credit issues? Perhaps the PBOC has eased. These are not good signs. If I take a look at TLT, why are bonds moving higher? Why did we get this big run up in bonds when producer price index came out 1%? That is an extraordinarily hot number. CPI 0.9%. These are really, really hot numbers. They are going to create upward pressure on interest rates. So why are bonds rallying? When bonds rally, interest rates go down. This is counterintuitive. You can see that I have an upward sloping trend line drawn for TLT, and you can see how TLT is actually giving us a little bit of a warning sign here as well. Now the market has shrugged off bonds for the most part. And if you can recall the big sell-off that we had in bonds back here, if I put up an overlay of the S&P 500, you can see bonds were down, 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 way down here. And what happens to the market? It lifts off. It just didn't care. Even when we had bonds selling off, you had the market lifting off. So it's not overly concerned with interest rates and yields yet, but it will be if the Fed decides that they need to move their tightening timetable forward. And there's no question that the Fed is going to have to start tapering. So we know that's just a matter of time when they start reducing their asset purchases. Right now, the economy is stable, so they should be unwinding those positions. What's the market going to do from here? I believe that we're going to have a very gradual drift higher from this point forward. The reason I believe that is that every one of these drops that we've had like this, you get this drop, and then you get two green candles like this, and then look at how tiny the candles get from here in. It's a sign of resistance. Buyers are very passive. There's some profit taking. We just kind of float higher. So we get another drop here. Two nice long green candles closing on their high. Then we just creep, creep, creep higher. And here we go again. Big drop, two green candles closing on their high. I believe we just start floating higher. So if you're a day trader, you need to be aware of these tiny little candles that are probably going to come into play. It means the daily ranges are going to collapse and that you should probably trim your size and trim your trade count. Typically, August is a very, very quiet month. It's a month when traders take time off. The Fed is in recess. You have Congress going into recess, so there's not a lot of news to drive the market. Once we get past earnings season, which will really be in July, so by the first week in August, things are already going to start slowing down. By the second week, they'll really come to a grinding halt. So if you're looking to take time off, as I am, that's the perfect time to do it. The second and third week in August are typically great times to take some time away from the market. Then things start heating up by about the middle of September. Middle of September through year end is fantastic. So we have that to look forward to, and I'm expecting that this year will also be excellent. Let's take a look at Pop Bull. It's the only search you really need. Let's take a look at these four stocks and see how they set up. SAVA. This stock is a monster. You can see a bullish flag right here. There's your flagpole. Stock pulls back, downward sloping trend line. Today, it gaps above that downward sloping trend line and it never looked back. Would I trade it here? I think it's going to continue to go higher on big volume like that, but I would not do an overnight swing trade on it. This stock moves like the wind. This is nice. You've got your flagpole here, downward sloping trend line. You can see how that trend line was breached. Long green candle closing on its high. Now we've got another long green candle closing through that horizontal resistance. Earnings on August 5th. So if you can get any kind of decent credit down around the 100-day moving average, yes, I think that would be a decent play. But you can see we're about $20 out of the money. So you're going to need a pullback, hopefully not more than that long green candle here, because then that breakout will have failed. Half of that long green candle will have failed, and you should not do the trade. So wait for it to pull back, wait for it to find support. If you get that opportunity at 250 down to the 235 strike, now you're 15 points out of the money. You might be able to get some credit for it. MS, Morgan Stanley. I do like this one. This one you might actually be able to go out and buy some calls on. They announced earnings here. You can see that the stock pulled back with the market, tested that 50-day moving average, massive bounce off that 50-day moving average, and look at this spike through horizontal resistance to a new all-time high. I was contemplating doing this as a call trade, and let's put up the 5-minute chart. You can see the beautiful relative strength that it had all day. In fact, let's bring up Goldman Sachs to see if it had a similar pattern. And it looks like it was also very, very strong. Let's bring up that daily chart. It's not nearly as strong as Morgan Stanley MS. So I would favor Morgan Stanley. You can see that this stock, Goldman Sachs, you might be able to get a bullish put spread off, keying off of that 350, 250 level. But I don't like this nearly as much as I do MS. MS looks really good, and I love this attempt at a breakout here. So if the stock starts to retrace tomorrow and it gives up half of this green candle and it checks that breakout and that support holds, and then you start seeing relative strength again and heavy volume, look at that volume, heavy volume, tick, tick, tick higher, this will be an excellent candidate for a day trade and possibly for an overnight swing trade because, again, remember the context for the market right now is that we're going to start floating higher. We've had our big drop, we've had our two long green candles. Now we can expect tiny little steps higher, which is okay. As long as we continue to see that progress, not a problem with that. But you have to be a little bit cautious buying calls because call premiums are more expensive than put premiums right now. We've got that volatility skew. You also have time premium decay working against you. Typically, on these financials, you're going to have very reasonable option premiums and very tight bid ask spreads. So let's take a look. Let's go out to the August expiration. We'll look at the August 20 calls and we'll go out to the 9250s. Well, let's see what we've got available in terms of strike prices here first. You can see that the stock is about 90, let's call it 95.50 to keep the math easy. That's $3 in the money. And you can see that these are currently trading with about $1.40 in time premium, which is very reasonable. And the bid ask spread is also fairly tight. We've got a 20-cent wide bid ask spread, so you should be able to middle that. Or in this case, you could probably buy those options for at most 440. I think you could probably get them in the middle at 435. Again, remember, these are very liquid options. They'll move point for point with the stock. So I like it. You don't have a lot of time premium decay exposure on this. If you want to play it a little bit safer, you can also sell some out of the money calls against the position. So you can pick any strike that you'd want and create a call debit spread to ride it higher and provide yourself with a little bit of added protection. TXN. Stock looked great. Everything's good here. We got a breakout. Uh-oh, what's that A? That A means that it's announcing earnings after the close, and it did not fare well after the earnings announcement. I believe the stock was down about 6 points after announcing earnings. If you were looking for stocks that might be rallying into earnings, there is a search called buy into earnings. All of these companies are within that 2-week window when they'll be announcing earnings, and 75% of the time over the course of the last 3 years, these stocks have rallied into the number. So the types of setups that I like here are stocks that have been flat, meaning they have not already started rallying. I don't want a stock that's already up 10% because that might be factored into the price already. I want something that's been sitting very nicely, very quietly, and that might set up a good opportunity. I can go through, I can click on the alerts, and so if the stock starts to break out to the upside, I'll know that that's one that I might want to pick up when it gets through that technical resistance. Here is a good example, and you can see I have a downward sloping trend line for Abbott. Abbott's still pretty quiet in here. It's above that 100-day moving average. It has a tendency to rally into earnings. You can see it announces earnings on 7/22 tomorrow. So this is not going to be a good earnings play, but here's an example of what you can expect. So the stock's pretty quiet. You're getting inside of that window, and now it's starting to gather some steam. I'm not going to go through all of these here. AMD got a bullish flag formation here. There's your downward sloping trend line. Stock puts in a fantastic day today. You can see how yesterday when the market fell apart, this is a great tell. And I think I'm going to close on this note. Earnings, 727. Stock breaks out to a new high. Everything's looking great. And then it just falls apart. It turns into mush. Again, this is exactly what I was trying to point out to you earlier. So if we get all excited about this breakout right here, this is a fantastic breakout on the stock. It's through major horizontal resistance. It's got heavy volume, all the types of things that we look for. And all of a sudden we get this long red candle off of the high and the stock falls apart. If we had sold an out of the money bullish put spread keying off that horizontal support at the breakout, we would have been flushed out of that trade for a loser. And now look, the stock's starting to recover. Here's what I like about this. Remember, Friday, the market was pummeled. That's what the stock did on Friday. It did pull back a little bit, but then on Monday, we really fell hard and the market tested the 50-day moving average. What did the stock do? It rallied hard off of the low. So let's go into a 30-minute chart. I know how to look at charts because I look at so many of them. So let's put that SPY overlay up and you'll be able to see the relative strength. And so here's the relative strength that I was referring to. Here you had the market getting annihilated right here. Look, the stock was down, but not much below the prior day's low. Okay, well, that's actually a pretty good showing given how far the market fell. Now, the market continues to drop here, but the stock is actually trading higher on the day. As soon as the market catches a bid, it's back off to the races. Let's go into a longer term view here. There's a nice downward sloping trend line that's been broken to the upside. So you can see AMD actually looks quite good. I like it. I think this is a stock that you're going to want to take a look at tomorrow. So you've got a long green candle almost closing on its high of the day, a doji that preserves that high of the day, followed by a long green candle. This is a very powerful pattern right here. So AMD, as choppy as the stock is, actually looks pretty good. You may want to try and sell it out of the money bullish put spread, keying off of that $85 support level at the 200-day moving average. And again, you don't have much time to work with because the earnings date is 7/27. So 7/23 this Friday would have been the last chance that you would have to sell it out of the money bullish put spread. The point is, this is a great list. This is one that you can use. You can go into custom search. If you want to look for these bullish put spreads, I suggest going out about 3 weeks or so. Look for those earnings that are going to be announced in 3 or 4 weeks. And so you would go into earnings projected date, and you would use a date that gives you at least a couple of expirations that you can sell. Can't really sell the 23rd because it's only 2 days away, but you could sell the 30th and you could sell the 6th of August. So what we'll want to do is we'll want earnings to be from the 7th of August. Let's go to the 9th because that's a Monday, and then you go out a couple of weeks. So let's say that we go out 2 more weeks beyond that, and we'll go out to the 20th. So these are the stocks that you want to be looking at. And you can do this. I should have done this with pre-earnings bull because that's really the search that I want. I want those stocks that are going to be rallying as that earnings date approaches. So we're going to use the same date here, the 9th and the 20th, and these are going to be your candidates right in here. Now I can add option liquidity. I can add weekly options because that way I will have more to choose from. I want to have excellent option liquidity, so I'm going to move this up. And now this is your list. You can knock right through that list and it won't take you long at all to do so. And you already know that HD sets up beautifully because I showed you that one. I still like selling that out of the money bullish put spread down here around that 50-day moving average, which is $315. So if you get any kind of pullback in the stock and you can get a 50-cent credit for the 315, 312.50 bullish put spread, I like it. The stock is compressing, and to me, it wants to go higher. I'm sorry I don't have any trades for you this week, but as I mentioned, I'm waiting for that sustained market pullback. I don't want to be head faked out of our positions all the time. Market is still very, very fickle. What looks good today looks weak tomorrow. So we're going to wait for a better environment, and then we'll be ready to hit it hard when conditions set up for us. Thanks so much. Have a good night. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.